Welcome to TalkTickers. You're here for the key takeaways from earnings calls, and today we're digging into Performance Food Group, PFG.
That's right, their fiscal 2025 second quarter call.
Yeah. Our goal, as always, is to really unpack what matters the numbers, what management's thinking, their view on the market, and the outlook.
And right away, PFG had a strong Q2. They actually beat their own guidance on both sales and adjusted EBITDA.
Okay, beat their own guidance, so a positive start.
Definitely, it signals some healthy momentum in the business.
Okay, let's get into those specifics then. Net sales, what was the growth there?
Net sales jumped 9.4%. Pretty solid.
9.4, okay. And the profitability, adjusted EBITDA.
Even better there, actually. It shot up 22.5%, landed at $423 million.
Wow, okay. That's a significant increase. Suggests they're managing costs well or getting better prices, maybe both.
Yeah, seems like improved profitability is a key theme. And looking at earnings per share, the diluted EPS was $0.27. But the adjusted diluted EPS, that hit $0.98. That's up almost 9% year over year. 8.9% to be precise.
Right, so your non-optimal's adjusted. So stripping out some items, their core operational profitability looks quite healthy and improving.
Exactly. More efficient, more profitable at the core.
So fundamentals look good. Where is this growth really coming from? They mentioned independent restaurants, I think.
They did, and that's a really important piece here. Organic case volume, so just looking at the core business, not acquisitions for independent restaurants, grew 5%.
5%, and wasn't that an acceleration?
It was, yeah. Up from 4.3% the previous quarter. And get this, in October and November, that specific number was over 7%.
Over 7. Okay, so really strong demand from the smaller independent places.
Seems like it suggests those businesses are, doing pretty well, or PFG is capturing more share there.
And what about the overall food service segment, organically?
Total organic case growth for food service was around 3%. So positive across the board there.
Okay. And Vistar, that's the vending concession side.
Vistar saw positive movement too. Yeah, total cases up 1.4%. Its growth, though maybe not as robust as food service.
Right. And just to clarify for listeners, case volume, that's literally the number of boxes of stuff they're selling. It's a direct measure of activity.
Exactly. A fundamental driver.
Yeah.
And we shouldn't forget the convenience segment either.
Ah, yes. C-stores. How did they do?
Positive total volume growth there too.
Yeah.
And management made a point of saying they're outpacing the industry in some key categories.
Gaining market share then.
That's the implication. Yeah. Seems like they're finding success in that space.
Now, PFG's also been busy buying companies, acquisitions. How are the new additions fitting in? Cheney Brothers was a big one, early Q2.
Yeah, and the early signs for Cheney are very positive, according to management. They said it's growing at a brisk pace.
Even with some weather issues down south.
Apparently so, which, speaks well for the integration in the business itself. And Jose Santiago, the acquisition in Puerto Rico from earlier in the fiscal year.
How's that performing?
Also doing well, hitting expectations.
Yeah.
And PFG seems quite bullish on the Puerto Rican market overall. They see it as increasingly important.
Interesting. And both of those businesses have strong winter seasons, right?
They do, which should give a nice boost to the fiscal third quarter results, the one we're in now.
Okay, so that makes sense. Let's break down the segments then. Food service, you said strong, but how strong?
Really stood out.
Yeah.
Double-digit growth on both the top line, sales, and the bottom line, profit.
And that includes the acquisitions.
It does include Cheney and Jose Santiago, yes.
Yeah.
But they stressed that the underlying sort of legacy PFG food service business also had strong momentum. Growth with independents and chains.
Okay, and convenience. You mentioned market share gain.
Yeah, and impressive profit growth too. They highlighted adjusted EVA growth, that's economic value, added up 28.5% organically.
Wow, 28.5 organic EVA growth. What's driving that?
They said it's new accounts and just winning more business. And specifically, their food service offerings within convenience stores seem to be a really key driver.
Makes sense. More prepared foods in C-stores these days. Now, Vistar sounded a bit more challenging.
A bit more mixed, yeah. They saw progress, case growth in areas like office coffee, theaters, corrections facilities.
Okay.
But they acknowledged facing some, broader industry challenges that are holding back the overall segment performance a bit.
Gotcha. Okay, let's talk financials. Inflation's always a hot topic. What did they report?
For Q2, overall company cost inflation was 4.6%.
4.6. How did that break down?
Food service was lower, 3.2%. Vistar was lowest at 2%. Convenience was higher, 6.7%.
Okay, so quite a spread between segments. Useful context.
Definitely. And despite those costs, gross profit was up significantly.
How much?
Increased by 14.4%. So they seem to be managing pricing and sourcing effectively.
And cash flow, always important.
Strong. First 6 months of the fiscal year, they generated $379 million in operating cash flow and $175 million in free cash flow after capital expenditures.
Solid cash generation. Now, that Cheney Brothers deal, big acquisition. It must have impacted their debt levels, their leverage.
It did, yeah. That was expected. The financing for Cheney pushed their net leverage ratio up.
Above their target range.
Yes, it moved above their target of 2.5 to 3.5 times earnings. Management was very clear. Bringing that leverage back down is the near-term priority.
Okay, priority one, deleverage. So what does that mean for, say, more M&A or share buybacks?
Well, they said the M&A pipeline is still, robust, lots of potential targets out there.
Yep.
But the focus right now is debt. So likely less M&A activity in the immediate future and probably lower levels of share repurchases too.
Yeah.
Balance sheet strengthening comes first.
Makes sense financially. Okay, let's look forward. Guidance. Did they update their outlook for the full fiscal year?
They did. They raised it. Full fiscal year 2025 net sales are now expected between $63 and $64 billion.
Up from
62.5 to 63.5 billion previously.
Okay, a decent bump. And adjusted EBITDA.
Also raised, now projected at $1.725 billion to $1.8 billion. They essentially raised the bottom end of the previous range.
So increased confidence for the full year. What about the immediate next quarter, Q3?
For Q3, they're guiding to net sales of $15.2 to $15.6 billion and adjusted EBITDA between $390 and $410 million.
Okay. And they mentioned the acquisitions smoothing things out seasonally.
Yeah, because Cheney and Jose Santiago have those strong winter selling seasons, it should make Q3 less volatile compared to historical patterns, a bit less of a dip maybe.
Interesting dynamic. Okay, so pulling back a bit, what were the key messages, the sort of subtext from the management discussion during the call?
Well, one thing was their confidence, or maybe cautious confidence, in hitting 6% independent case growth for the full year.
Cautious how?
They kind of caveated it by saying it depends somewhat on the macro environment improving. So they feel good, but acknowledge external factors.
Fair enough. What else?
A big focus on growing SKUs, or line items, faster than cases, which basically means selling more different things to their existing customers. Deeper penetration.
Right, increasing the share of wallet.
Exactly. Also, ongoing focus on cost optimization, more collaboration between the segments to find savings.
They expect Vistar to remain challenged, though.
Yes. For the rest of this fiscal year, though they noted the year-over-year comparisons get easier, so maybe the growth rate looks better even if challenges persist.
Okay. And inflation outlook for the rest of the year?
They expect it to be pretty similar to Q2 levels, segment by segment. So, low to mid-single digits for food service, low singles for Vistar, mid-singles for convenience.
And things like tariffs, how do they view those?
Pretty much like inflation. A potential cost increase they'd largely look to pass through.
Got it. What about the restaurant landscape itself? New openings?
They said new restaurant formation is continuing, especially again in the independent space. That seems to be a resilient area.
And they're investing behind that growth. Cheney hiring salespeople.
Yet Cheney is actively hiring more sales reps. They also mentioned that private label penetration PFG's own brands is lower in the acquired companies compared to legacy PFG.
So an opportunity there to introduce their brands.
Potentially, yeah. A synergy opportunity down the road.
How about the chain restaurant side?
Seeing improvement there, too. Good performance from some key accounts, better customer mix overall.
And the Cheney integration, any synergy targets?
They reiterated the $50 million synergy target by the end of year 3 post-acquisition. But they expect more of that to come in years 2 and 3, not immediately.
Okay, makes sense. Integration takes time. They also mentioned hiring more salespeople overall, didn't they? Not just at Cheney.
Yes, a deliberate move. They said their sales force headcount is up about 7% overall, mostly experienced industry hires. It's an investment in future growth.
Fueling the engine.
Pretty much. And they also highlighted selling food service products into the convenience channel through both their convenience division and traditional food service routes. Seems like that's gaining traction.
Interesting cross-selling. And finally, any details on financial structure stuff like interest expense or D&A?
Basically said Q2 numbers are a good baseline going forward, reflecting the debt taken on for Cheney.
Okay.
They also noted the gap between their reported growth and their organic growth might widen in Q3 because the acquisitions are seasonally stronger then.
Right, the inorganic piece gets bigger temporarily.
Exactly. And crucially, the raised sales guidance for the year is mostly driven by higher volume, not higher inflation pass-through.
Good clarification.
Yeah.
Underlying demand is the key driver. And they mentioned Q3 is big for the acquisition.
Yes, the biggest quarter for both Cheney Brothers and Jose Santiago, historically.
Makes sense. And for debt paydown, any specifics on which debt?
Initial focus is the ABL, the asset-based loan they likely used for the deal. But they'll look at their callable bonds, too.
Okay. Last point from them, performance brands, their private label.
Yeah, about 53% of their independent business currently. Long-term potential to grow that, but it might dip slightly in the near term as the acquired businesses with lower private label mix get fully integrated into the numbers.
Got it. Lots of moving parts. Okay, let's shift to our speculative corner. And remember, folks, this is absolutely not financial advice, just a wild, maybe plausible idea to think about.
Always the fun part. Let's hear it.
All right, so PFG did this big deal, Cheney. Their debt went up. They're laser focused on paying it down. Performance is strong. Independents are doing well. What if? What if the play isn't the stock? What if it's the debt?
Okay, betting on PFG bonds or loans. Explain.
Well, think about it. If they execute well, keep generating cash like they have been, and aggressively pay down that debt as they promised.
Their credit profile improves.
Exactly. The risk associated with their debt decreases. And when perceived risk goes down, the value of existing debt, especially if it's fixed rate bonds trading below par, for instance, could potentially go up.
So the outrageous part is betting on the debt of a company that just levered up for a big acquisition.
Right.
And the plausible part is their strong performance and stated commitment to deleveraging actually makes that debt safer, potentially increasing its value.
You got it. It's like a backdoor play on their operational success and financial discipline. You're betting on management doing exactly what they said they'll do regarding the balance sheet.
It's definitely speculative. Lots of risks there. Interest rate movements, overall credit market conditions, execution risk. PFG actually has to perform and pay down that debt.
Oh, absolutely. Huge risks. Depends entirely on their execution and the broader market. So again, pure speculation. Do your own exhaustive research. Probably don't do this. But it's a thought.
An interesting angle for sure.
So that wraps up our deep dive into Performance Food Group's Q2 fiscal 25 earnings call. We hit the financials, the segment performance, acquisitions, guidance, management commentary.
And that little speculative detour into the debt market.
Right. Hopefully this gave you a much clearer picture of where PFG stands and where they might be headed.
Lots to digest from that call.
Definitely. What are your thoughts? Is the focus on debt reduction the right call? Are you bullish on the independent restaurant recovery they seem to be banking on? Let us know.
Always interested to hear different perspectives.
And just the standard reminder, this was all for informational purposes. It's a summary and analysis, definitely not financial advice. Do your own homework.
Always.
Okay, tune in next time for another TalkTickers deep dive into the world of earnings.